rare situation is allowing you to buy some ETF stocks for 50% off. Learn more at crushthestreet.com/profit2017.
Hello everyone and welcome into crushthestreet.com. I'm Kenneth Amaduri. I got a returning guest today, Ronni Stoeferle. He's a head of research and investment funds at Incrementum AG. And of course, the reason why I wanted to talk to him today is because he had released the 2017 edition of In Gold We Trust. And I want to talk about that today. The extended version is a thorough 169 pages. And for those with the short attention span, there's also a compact version, 29 pages. But of course, right here, we are going to interview the man himself to give us a little idea of what this year's report has to say. Ronni, thanks for coming on the show with me today.
Hi, Ken. Thanks for inviting me again.
Well, let's talk about this report, sir. Any new updates? What is the significance of 2017 and what we are seeing today in the 2017 edition of In Gold We Trust?
Well, I have to tell you, Ken, every year after releasing the In Gold We Trust report, we say, man, it's been so much work. Next year, we're going to write a bit less, maximum 100 pages. And then 1 year later, we publish 150, 180 pages again, because there's just so much to write and so much to research and analyze in the gold space at the moment. And as you know, we don't only analyze gold. It's more about the whole monetary system. It's about inflation. It's about history. We're writing about Bitcoin. We were writing about populism and its true cause. We're writing about recession in the US that is highly likely from our point of view. We're writing about the portfolio characteristics of gold, about mining shares. So there's many topics to discuss, and I think one of the most important highlights of the report is, first of all, we are seeing kind of a confirmation of last year's conclusion that we're in the early stages of a new bull market again. We're saying that the next US recession is already on the doorstep. We're thinking that the populism that is coming up is only a symptom of an economy that is not doing very well. We're seeing the de-dollarization that has just begun, and we're coming to the conclusion, basically, that from a technical but also from a sentiment and from a fundamental point of view, gold looks very attractive at the moment.
Well, let's go down some of the lists of some of these things. Real assets are at all-time lows compared to financial assets. And that was one of the things that you had talked about in this report here. And I'd like to go over that here in this part of the interview.
Yeah, I mean, we call it the everything bubble. That's a term that Jesse Felder already coined a couple of months ago. And Kenneth, just to give you one number, in the first quarter of 2017, the amount that was printed by the biggest central banks was $1 trillion US, just in one quarter. You could buy every human being on this planet 1/10 of an ounce of gold. So this monetary liquidity supernova that we're seeing at the moment, of course, has effects, and those effects are mostly asset price inflation. So we are seeing that real estate prices, that share prices, that bond prices are at or very close to their all-time highs. While on the other hand, commodities and gold are trading on an absolute, but especially on a relative basis, on very cheap terms. And the everything bubble that we're describing, it shows financial assets of households in relation to disposable personal income. And you can clearly see from this chart, which is on page 8 of the report, there was the dot-com bubble, then a huge bust, then there was the housing bubble. We know, great financial crisis, 2008, 2009, and now we are already much higher than on the preceding bubbles. And we should not forget that the last bubbles, they were limited to certain sectors. Now we're seeing this everything bubble. So this also means that the next crisis, the next bust, will of course be significantly bigger than 2008. And from our point of view, you just want to have some sort of insurance, and this insurance should be golden in such an environment.
Yeah, I know some different analysts out there have made some predictions as to if the gold was to be revalued, for how many dollars have been printed or fiat currency. It would be $10,000, $20,000, or $50,000. Obviously, a lot higher than the current $1,250 that we seem to be stuck with, or at least in this trading range for quite a while here. So, talking about the dollar specifically, strong dollar supports disinflation in quotation marks there. And that's something that I wanted you to explain here. You talked about that in your report, and I wanted to explore that. Disinflation.
It basically means falling inflation rates, and this inflation in general is a very negative environment for gold. Kenneth, let's not forget in 2011, when gold was trading at 1900, inflation rates in the US year on year were 4.4%. Since then, we have seen falling inflation rates, and based on our analysis, we're really crunching the numbers. We found out that disinflation, meaning falling price inflation, is by far the most negative environment for gold. So, of course, this also leads to the conclusion that a strong dollar environment, which we mostly see in disinflationary scenarios, is a negative environment for gold. And we have seen that the dollar index was trading at the 14-year high at the end of last year. So we're, from our point of view, at the very end of a strong dollar environment. So the disinflation should be mostly over. We're seeing from very quite a lot of signs that inflation numbers have bottomed out last year, and that rising inflation rates are in the cards. And we should not forget Donald Trump, and we're writing quite a lot about Trump. He's very vocal when it comes to the reindustrialization of the U.S. economy. And from our point of view, the most important driver of this reindustrialization will be a weak dollar policy. So Donald Trump wants a weak dollar. There's a significant amount of quotes from Trump where he says this strong dollar is killing us. We need a weak dollar. And it seems that we have seen the highs in the dollar, and I would say that the next couple of years we're gonna see a weak dollar, and this should be which is the flip side for gold and commodities. This should be an excellent environment for commodities and for gold. So I'm seeing a weaker dollar. The US dollar bull market seems to be past its prime, and this goes hand in hand with a U-turn of the Federal Reserve, because the whole world now believes that the US economy is doing so well, and that they're on a rate hike path, and that the Fed is extremely hawkish. From my point of view, that's nonsense. The Federal Reserve will have to do a U-turn sooner or later, because we are seeing a huge gap between the soft data and the hard data. Economic confidence is pretty high, but the hard data in the US does not confirm those surveys and so on. So from my point of view, a recession going forward is one of the biggest catalysts for gold, because a recession is an excellent environment for gold, because gold anticipates, it discounts that the Federal Reserve will change its policy, that they will lower rates again, that there will be another round of quantitative easing, perhaps helicopter money, negative rates, whatever, and that there also might be some sort of fiscal stimulus. And this will exactly be the point when gold starts to pick up momentum.
Okay, so Ronni, I want to resolve that point right there, and that is the confirmation of gold's bull market. You alluded to that we started it in 2016. And was there anything else, whether it's from a technical basis or what have you, maybe what we're seeing in the mining shares, that is confirming gold's bull market trajectory?
I think there are quite a lot of positive signs. Actually, nobody really cares about gold, but still, gold made a decent performance last year. So gold in dollar terms, it was up 8% last year. In dollar terms, it's up 9% since the beginning of the year. Gold was making positive gains 2016 and 2017 in every currency. So that's already showing some sort of market breadth. Very good sign. Then we can see that the relative weakness versus the stock market is weakening. So I think gold relative to the S&P is kind of bottoming out, and I think that the roaring bull market in equities is some sort of the biggest opportunity costs for gold. And then we're seeing that basically from institutional investors, nobody really cares about gold at the moment. So that are all pretty positive signs. And we're seeing, based on the Bloomberg consensus, the average analyst sees gold trading around 1,100 for the next 3 or 4 years, which is a level that I just don't think that we will just go sideways. For the mining stocks, I'm pretty bullish. We have seen a tremendous amount of creative destruction within the sector. I think, for example, the free cash flow of the companies in the gold bucks index last year was higher than in 2011 when gold was trading at 1,900. So the companies really did their homework. They reduced their debt burdens. They got their costs under control. They restructured their balance sheets and so on. So there are lots of positive signs. And let's not forget, Ken, the last bear market in mining stocks was the longest in history. So therefore, for me, it's crystal clear that the next bull market will be quite interesting, I would say, and since the bottom of the market, mining stocks are up 100%. But if you compare it to other bull markets, and we've got a great chart on that, this is only the beginning. And as I've said before, nobody is really invested in mining stocks. Just to give you one number, just the cash hoard of Apple, you could purchase the entire gold bucks index 2.5 times, or you could alternatively buy 6,500 tons of gold. So I think there's a tremendous amount of value in the sector, and if my assumption is right, that gold is in the early stages of a new bull market, then mining stocks are a bargain.
Yeah, absolutely. That was one thing that I definitely want to cover there. The chart on page 138, for anyone who is following and has the report, really is such a clear indication of how early we are in historical bull markets. Really, if history is going to rhyme or repeat, we are so early in this bull market stage. And I like what you were saying there. We were in this huge bear market, and so therefore the equal and opposite bull market should be rather impressive. And I think we got a taste of what it was like in the first part of 2016, but surely that isn't the end-all be-all, considering all that we've been through. So any additional thoughts on that?
Yeah, I mean, I think from, when it comes to the mining stocks, I think that we are focusing on very conservatively managed companies. So we don't want growth at any price, but we really want to have management prioritizing shareholder interest. And I think that, of course, there's a large valuation discount when it comes to mining stocks. But the miners, they did a poor job within the last bull market. So, and I think they have to regain confidence by the market again. But I think that from a technical point of view, having a look at the sentiment, having a look at the seasonals, having a look at the positioning, I think the risk reward ratio for the mining stocks and for gold, and also for silver, of course. We regard silver just as a leveraged play on gold. I think it's just a very, very attractive risk-reward ratio at the moment. And one pretty interesting thing that we did in the summary of the report, we said, okay, if you don't want to be bullish on gold, you can ask the question, when will I not need any gold in my portfolio? Mm-hmm. And the answer would probably be when the debt levels can be sustained or are reduced, when the threat of inflation is low, when real interest rates are high, when confidence in the monetary authority is strong, when the geopolitical environment is steady and predictable, when the geopolitical situation is stable, and when governments deregulate markets and simplify tax regulations, respect civil liberties, and so on. Do we really see that? I don't think so. We're seeing exactly the opposite. So we are making a very strong case for gold, and I think we're giving a number of reasoning for that. And your listeners have to find out more about it by reading the report. It's totally for free, and it's available on our webpage, of course.
Ronni, I want to ask you real quick, just a brief general idea on what do you suggest for portfolio characterization. You brought that up at the beginning. You mentioned that was one of the things that people can learn about in your report. So what is your general recommendation for people when they invest in gold and silver, and how to fit that into a portfolio?
Well, from my point of view, gold has to be in every portfolio, and for us, it's always important to make the case why you should own gold in your portfolio. I think that it depends, of course, on your time horizon. It depends on your risk preference and so on. How high the allocation is. There's a number of academic studies suggesting a portfolio allocation between 7 and 15%. I would say you can at the moment hold even more, up to 25%. Definitely makes sense. And I think that if you're expecting rising inflation rates, if you're expecting stagflation, for example, if you're expecting a negative environment on the stock markets, just from portfolio perspective, you should own gold. And therefore somebody once told me that the percentage of your gold holdings should be as high as your expectations that there will be a major crisis going forward. So if you say, okay, chances are, I don't know, 30 or 40%, then you should perhaps hold 30 or 40% gold. If you say, no, everything is fine, there won't be any crisis going forward, then you should hold significantly less. So there's no, I would use that as a rule of thumb. But at the moment, I think when everybody is underweight gold, I think it just perfectly makes sense from a contrarian point of view to be overweight gold.
I actually agree with that quite a bit. Over-allocate in the present time with it being so undervalued, and then slow it down at a later time. I completely agree with that. All right, Ronni, let's transition over a little bit. We're in brand new territory here with Bitcoin. It hasn't exactly come into the conventional portfolio allocation of 5% now in cryptocurrencies, 10% in gold, 80% stocks, and 15% foreign stocks type of thing, or bonds. Cryptocurrencies are just brand new, and really they've been just in people's speculative portion of their portfolio. Some people who went really aggressive at the right times have become instant multimillionaires in things like Bitcoin. But from your perspective, the research you've done, and just kind of where you are, what are your thoughts on Bitcoin? And in general, what was the general thought in the report towards it?
Well, we're writing about Bitcoin for 3 or 4 years now already, and at Incrementum we came to the conclusion that it's not just it evolved from a curiosity, and now is an investment case. So we expect some news from our side, first of all on research, but also on products in the Bitcoin and cryptocurrency space. I think from a very Hayekian approach, competing currencies. That's what it's all about. The market should decide what the best currency is. And will Bitcoin be around in 2 or 3 years? I don't know. I think so. Will all of the other, 500 new cryptocurrencies be around? Probably not. But the technology will be around. And the technology, the blockchain technology, and all the rest of the stuff that is coming up now, this will change some industries fundamentally. For example, for utilities, but especially for the banking sector, the blockchain technology offers a tremendous amount of opportunities. So from my point of view, I think that if you read the white paper of Satoshi Nakamoto, he knows the Austrian School of Economics, and he often refers to things, like the logo of Bitcoin, then the mining of Bitcoin. I think there are many similarities when it comes to gold and Bitcoin. And the most important one is the stock-to-flow ratio. The stock-to-flow ratio of Bitcoin is rising. So the inflation rate of Bitcoin, due to this halving that takes place every 4 years, the inflation rate of Bitcoin is actually falling, which buys credibility and trust. Because it cannot be inflated at will like fiat currencies. So I think that Bitcoin and the whole crypto space is really, really interesting, especially as people are discussing money again. So they are actively discussing, is Bitcoin money? What are the characteristics of good money? And I think that's really an important discussion that is made currently. But we should not forget that the sector is still fairly small. So the market cap of Bitcoin is at the moment, I think it's 50 billion. Compared to gold, the market cap of all gold ever mined is roughly 7 trillion. We should not forget that for an institutional investor, it's basically impossible to invest in Bitcoin and in cryptocurrencies. So I would expect, if this financialization of the Bitcoin happens, then Bitcoin can go to 10,000 or even higher if there's really big money piling into the sector, if there are futures, if there are ETFs, and there will be investment products going forward. Then I think we're just at the beginning. But yeah, as I've said, we should not forget that the track record of gold is 5,000 years long, and the track record of Bitcoin is only a couple of years. So I wouldn't say okay, either gold or Bitcoin. I think it has slightly different characteristics, and I think that Bitcoin is should be in a portfolio, but of course, due to volatility and so on, the amount should probably lower than the allocation in gold. But I think it's, as I've said, from an intellectual point of view, it's just so interesting what's going on. Such a dynamic sector, so much innovation, and I think that's really something very, very positive.
Absolutely. And I know there's a lot of Bitcoin purists out there that believe it is equivalent to gold. And certainly the fact that there are infinite possibilities for competing currencies makes Bitcoin, in a sense, indistinguishable to a certain degree. It's not 100% unique as gold is, which is very, very finite and cannot be easily replaced. Bitcoin cannot easily be replaced at this moment because there's an infrastructure built out, but the technology can, and over time it can be replaced, and we are even seeing that now with Ethereum's rise, almost surpassing Bitcoin's market cap. So the possibility is certainly out there, and I know exactly what you mean. But on the bullish side for Bitcoin, I guess I just didn't really wrap my mind around what you just said about the fact that institutional money cannot enter Bitcoin at the current market cap, or even cryptocurrencies, being around 100 billion at the moment, because it's just too small. It's not tradable. So the fact, once that happens, which I think it's inevitable that eventually cryptocurrencies are going to be part of institutional areas where they invest money, the prices have to go higher unless it just gets diluted amongst thousands of cryptocurrencies. If it's just a matter of investing in the top few, oh my gosh, that could seriously mean for a much higher Bitcoin, Ethereum, and Litecoin Dash price. So just some interesting thoughts
Absolutely.
there that you brought up that I guess it just really connected with me that I've heard before, but it made sense the way you explained it there. All right, Ronni, I want to ask you about I guess this new populism. One of the things you talked about, what is new populism as opposed to old populism?
I think that there's not too much new under the sun. So if you study history, we've always had populists, and those populists were always most successful when the economic situation was weak or deteriorating. So we discussed it already last year when we said the odds that Donald Trump will win the elections are much higher than the market sees, and we know how it ended. So we just to give you one, I think that's really a very disturbing number and chart. We're showing on page 52 of the report the share of households with stagnating or declining income between 2005 and 2014. So in one decade, in Italy, for example, 97% of all households had falling incomes. In the US, it was 81%. In the UK, it was 70%. In the Netherlands, 70%. In France, 63%. So we're seeing in all industrialized countries in 75% of the households, we're seeing declining real household incomes. And this clearly leads to the conclusion that the economy is not doing very well, and that people are voting for change, and they are voting against the status quo. We've seen this in the US, we have seen that with the Brexit, we have seen that with basically every major election in Europe. And therefore, from our point of view, this populism coming up is only a symptom, and not because people just are so changing to the left or to the right and just like populists now. We're seeing that industrial production is getting weaker and weaker. We're seeing a growing discrepancy between productivity and the real median family income. So from our point of view, this populism that is coming up is only a symptom, and this clearly shows that the economy is probably that the real economy is doing much worse than all those pundits sitting in central banks or big banks are communicating. So from my point of view, as I've said at the beginning, we're much closer to a recession that many people anticipate, and there's so many signs showing that. We're seeing falling tax receipts, we're seeing falling credit growth. Auto sales were extremely weak. Retail sales were weak. So from my point of view, a recession will happen this year, perhaps next year. But I think that the most important thing is there's one terrific chart in the report showing the 89 analysts that are questioned by Bloomberg. So this is like the top-notch, the most important economists sitting in central banks and in big banks all over the world. And out of those 89 economists, zero is expecting a recession in the next 3 years. So this is such a huge consensus that as soon as recession fears come up, and from my point of view there are many signs indicating that, there will be major shifts in investment allocation and major shift in markets. And this is probably, as I've said before, this is going to be the main catalyst for gold going forward.
I just read a statistic the other day, and I want to say it was 16 out of the past 100 years, 16 out of the 19 last rate hike cycles were followed by a recession. And we're seeing the flattening of the yield curve now. So many things that are indicating historically on, a rhyme or a repeating type basis here that a recession is certainly coming. We're 8 years now from the last major economic crash. How long can this actually go for? And we're essentially still at 0% interest rates. At least the last time they were able to lower it for a while, and now we're essentially at zero, which a lot of people are saying the reason we're seeing these quarter point increases periodically here is just so the Fed can lower them again, or at least have some room to do something to inject some sort of a psychological stimulus into the market. Because again, that's a huge thing that the Fed depends on. It's this mindset of the economy. If they can control the mindset, they can kind of keep things going the way they want it to. And once they lose that, they have nothing left. So, Ronni, I want to thank you for coming on the show with me today. If you have any concluding thoughts here, I'd love for you to share them, just a general recap or any sort of words of advice for the audience as we close here. And of course, let people know where they can find your latest report and reach out to you if they're looking for any of your services.
No, I mean, as I've said, there's the big report. Perhaps it's some sort of a weekend or a vacation read with 170 pages. There's also the compact version. It's important from our point of view. We're giving this holistic view, very much influenced by the Austrian School of Economics, of course. And yeah, you can find the report on our webpage, ingoldwetrust.report or incrementum.li. It's totally for free, and I think it's a really interesting and inspiring read, and I'm already kind of thinking about new charts and new chapters to write for the next In Gold We Trust that will be published June 2018.
Well, and we will be sure to have you on the show again and to discuss the report once again. But hopefully we'll talk before that and get an update from you maybe towards the end of the year to see how things are going and get an update from you. So Ronni Stoeferle.
Excellent.
Ronni, thanks so much for coming on the show. Appreciate it.
Thanks, Ken. It's been a great pleasure. Take care. All the best.